Quest chips are getting called up to the big league, and that should make established players nervous. So I'll decode that introductory statement a bit later in this content, but on April 9th of 2025, the Simply Good Foods company reported its fiscal 2025 second quarter earnings for the period ending March 1st of 2025. And I'll be utilizing those financial statements along with notes I took while listening to the earnings conference call and any relevant publicly disclosed information to obviously update you on how the Simply Good Foods brand portfolio performed recently, but also utilize everything as the contextual backdrop for my expanded strategic commentary around convenient nutrition market dynamics and trends. And for those newer to my quarterly content on the Simply Good Foods company that might not be super familiar with the functional CPG brands that are within the portfolio, it's Quest Nutrition, Atkins, yes, originating from the Atkins diet, and Only What You Need, or better known as Owen, that was acquired on June 13th. So that means there will be some acquisition related financial impact within the year-over-year comparatives from Owen, which I'll do my best to highlight when meaningful. Okay, enough with that House of Brands housekeeping stuff. Let's get into some of those financial numbers first. In the second quarter of fiscal 2025, the Simply Good Foods portfolio reported generating revenue of $359.7 million, which was up 15.2% year over year. But don't get too hyped on that growth percentage because when you take into consideration the non-comparable revenue contribution from the Owen acquisition, organic revenue growth was only 4.4% year over year. Yet a sharp decline within international markets caused a negative percentage point of impact to overall organic revenue. Then on a quarter over quarter sequential basis, revenue was up about 5.4%. Looking quickly at the margin side, the company had quarterly gross margins of 36.2%, which was down 120 basis points year over year and 200 basis points quarter over quarter. It was noted that the declining gross margins resulted from the inclusion of Owen. But jumping back into revenue-related insights, the total Simply Good Foods retail takeaway for the 13 weeks ending March 2nd of 2025 increased about 7% year over year across US measured and unmeasured channels. As a portfolio, the Simply Good Foods company is below the measured channel nutritional snacking categorical average of about 12% growth. But as you'll hear in the next sections, that's due to the Atkins brand severely dragging down the positive performance of Quest Nutrition and Owen. So let's separate out the portfolio brands and we can start with a review of how Atkins Nutritionals performed during this quarter. And even if you haven't been an avid follower of my content for the past several years, I guess you could intuitively assume that it's been tough sledding recently for legacy brands positioned within the weight management category. This has been made even more complicated with the approval of several pharmaceutical weight loss solutions. But even though the weight management category is evolving, company-supported consumer research shows that 80% of consumers are looking to lose weight or maintain a healthy eating lifestyle. And Atkins is distinctly and uniquely positioned as the most trusted low-carb, low-sugar solution. Moreover, when consumers try Atkins products, they are pleased and delighted. Yet, as you'll notice from the brand results this quarter, there continues to be a disconnect between what people say about the Atkins brand and the company's ability to properly reach those people to create positive commercial results. But I'm not telling the Simply Good Foods team anything they don't fully acknowledge already, as the company is currently midstream and on track around the execution of its 5-point Atkins revitalization plan. Additionally, the brand's revised Atkins Way advertising that aligns with the evolving consumer views and conversation on weight wellness has received positive feedback and should provide a much needed tailwind for Atkins. But in the second quarter of fiscal 2025, retail takeaway in the US measured and unmeasured channels combined for Atkins brand being down 10% year over year. But while performance was terrible, these poor results are being blamed entirely on cutting certain low ROI marketing programs at key customers. And just to highlight a bright spot, performance in January and February were reported to be significantly better than December. So That would presumably mean that early indicators of the Atkins revitalization plan show positive momentum. But throughout fiscal year 2025, the Atkins revitalization plan will move into its next phase that seeks to enhance profitability and long-term sustainable growth. But it was warned that strategic actions focused on a smaller brand footprint could create further short-term revenue headwinds. Yet expected distribution losses and associated shelf space are being repurposed to benefit Quest Nutrition and Owen. And maybe this would be a great time to transition the content into examining the recent performance of the convenient nutrition brand that continues to outshine its legacy brand portfolio counterpart. In the second quarter of fiscal 2025, retail takeaway for Quest Nutrition across the measured and unmeasured channels combined increased around 13% year over year, continuing to perform at or above the active nutrition segment of the convenient nutrition category. And the brand's strong performance has been driven by an increase in household penetration, significant base velocity growth, increasing buy rates, distribution gains, and new product introductions. Looking at the specific Quest Nutrition product categories more closely, the specific retail takeaway growth percentage of bars was not mentioned this time, but leadership did discuss that it was below categorical average and largely in line within the important convenience channel. So with Quest Bar recent performance lagging internal expectations, Simply Good Foods leadership fast-tracked a new bar format innovation called Quest Overload that recently launched and has been getting strong initial feedback. Beyond the new bar platform, it's important to remember that Quest Nutrition hasn't shied away from bar format innovation or renovation activities recently, from enrobed variants to mini sizes and even consistently revamping formulations. And though it was a higher proportion in 2019, the bar segment still accounts for about half of the total Quest Nutrition retail sales, and its success allows the brand to take on additional innovation risk in other product categories. But let's next shift into the snack segment, and more specifically salty snacks, which I've stated countless times previously is where the excitement and primary focus should be placed within Quest Nutrition. And in the second quarter of fiscal 2025, retail takeaway for Quest Nutrition in its salty snack segment increased 45% year over year. Moreover, Quest chips now represent about 35% of the total Quest Nutrition retail sales and provides a substantial share of new customers into the brand. But maybe that's a good transition into examining what I was referring to within that introductory statement. Over the last several years, Quest Nutrition has grown its salty snacks platform to over $300 million in retail sales. And while that's super impressive, I believe there's a realistic path to doubling retail sales over the near term. Some of that strategic growth playbook will, yes, rely on big I and little I innovation activities like building upon current platforms and entering new adjacent categories ripe for disruption. And yes, Quest Nutrition will continue increasing brand awareness through highly effective marketing campaigns. However, the single most important piece of this strategic growth playbook will revolve around expanding physical availability of the Quest Salty Snacks platform. And you could start this impact analysis by considering where the Quest chips have historically been merchandised within large food and mass retailers. While these healthy living by the pharmacy sections are a great starting point and Quest Nutrition is the categorical leader in that merchandising set, it has a much lower foot traffic compared to mainline snacking aisles or other impulse purchasing placements. But long-term secular wellness and convenience trends have converged in such a mainstreaming way, especially around high protein, low carb, low sugar products, that retailers are being forced to reconfigure merchandising within snacking categories. So utilizing its categorical leadership for leverage, Quest Nutrition has made increasing the physical availability of products a significant initiative within the organization, and recently landed a Quest Chips mainline snacking aisle test within a large mass retailer. And if proven successful, I believe it would create a massive snowball effect that leads to increased display support, merchandising everywhere, and even new sales channel penetration. But you might be wondering just how big the conventional market leaders are in, say, tortilla chips, since that's the style of Quest chips that are most popular. In 2024, Doritos was the US market share leader with approximately $3.7 billion in retail sales, while Tostitos had $1.6 billion in retail sales last year. So considering the size of broader salty snacks category and the low household penetration and Quest Nutrition brand awareness, along with the strong brand loyalty rates, sales velocity, and incrementality, the setup is exceptionally positive for the salty snacks segment of Quest Nutrition. That being said, the only potential landmine I see ahead would be solving the manufacturing capacity issue, as consistently supplying sharp increases in demand has proven historically elusive. But then finally, let's analyze what's going on with the newest Simply Good Foods portfolio brand, Owen. And I'm not sure how long everyone will continue to allow me to kind of take this victory lap, but as I documented in content previously, I predicted Simply Good Foods would acquire the plant-based protein shake brand way back in early 2021. Why? Simply put, Owen aligns with the Simply Good Foods portfolio platform strategy, and it reaches a new incremental consumer segment that's highly appealing. Additionally, Owen continues to be one of the fastest growing RTD protein shakes in dollar sales and one of the largest sports nutrition multi-pack brands in the market. In the second quarter of fiscal 2025, retail takeaway growth of Owen across the measured and unmeasured combined channels was about 52% year over year, coming from a balance of distribution gains and velocity growth. Moreover, Owen has significantly accelerated performance across all major sales channels, including e-commerce and all key retail customers. And if you're curious to know when distribution gains could subside, the brand's ACV is currently 62%, which means that Owen is still 20 percentage points or more below the protein RTD beverages market leaders. Then in terms of sell-through, Owen currently has 50% higher velocity relative to key plant-based protein RTD competitors. Oh, and Owen has a powders business that's comparatively small, around $25 million in retail sales, but is growing triple digits year over year and will likely play an increasingly important role within the brand's growth story over the next several years. Also, the Owen integration work stemming from the M&A transaction is progressing as planned, and Simply Good Foods will capture about 80% of the cost synergies by the onset of fiscal 2026. And as I predicted from the very first Owen M&A content, Simply Good Foods leadership underestimated the brand's growth potential and recently increased its fiscal 2025 full-year net sales projections. But to be completely honest, its internal brand projections are still way too conservative, especially if they don't intentionally restrict ACV growth or store-level trade promotion activities that lessen velocities, incremental store placements, and items per store growth. So I only see positive near-term tailwinds ahead in terms of brand strength and awareness improvements, especially with Owen getting a boost from Simply Good Foods' go-to-market scale, capabilities, and category advisor relationships with every top retailer. Finally, while I'm not sure any new or groundbreaking products will get released in fiscal 2025, but it would be silly to think under the ownership of Simply Good Foods that Owen wouldn't expand into new formats in the near-term future. But I just wanted to end with a quick final thought about potential cost inflation regarding the Simply Good Foods brand portfolio. By and large, Simply Good Foods is not greatly impacted by real and potential Trump tariffs outside of packaging elements. That being said, the brand portfolio has been contending with inflationary impacts within commodities like cocoa and dairy proteins. But interestingly enough, the strong growth in Quest chips has helped mitigate overall effects, as ingredients outside of dairy proteins have recently experienced no meaningful cost inflation. But I hope you enjoyed the first principles thinking that went into my latest YouTube video. If you did, can you do me a favor by hitting that like button? That quick and free action helps YouTube know my content is worth spreading to more people. Also, we're getting really close to reaching my next subscriber goal, and it would be great if you join me on this journey. But to do that, we need to fix the fact that slightly more than 3/4 of you that are watching this video right now are not subscribed to my YouTube channel, and that hurts my feelings. Regardless, I want to thank you for giving me some of your attention and time, and I'll see you on the next one.